How to make money with DeFi. How much money can you make in DeFi? What is the best way to invest in DeFi? And what exactly is DeFi? Don't worry guys, we will discuss everything. So welcome to CryptoTrends, where in today's video, you will get to know 4 ways DeFi can generate passive income, so make sure to watch the video till the end, and don't forget to like and share the video. What is DeFi? DeFi is an abbreviation for decentralized finance. It is an umbrella phrase for the crypto universe's efforts to create a new internet-native financial system by replacing old intermediaries and trust mechanisms with blockchains. So what do you mean by using blockchains to replace traditional intermediaries and trust mechanisms? Well, let's take a step back. In the traditional financial system, intermediaries such as banks or stock exchanges are required to send or receive money. And in order to feel at ease with the transaction, all parties must have faith that the intermediaries will act properly and honestly. These middlemen are replaced by software in DeFi. People trade directly with one another instead of going via banks and stock exchanges, with blockchain-based smart contracts doing the job of generating markets, settling trades, and ensuring that the entire process is fair and trustworthy. So DeFi is crypto's version of a stock exchange? That's a factor. However, DeFi also covers loan platforms, prediction markets, options, and derivatives. Essentially, crypto enthusiasts are creating their own version of Wall Street, one that is largely decentralized and only deals in cryptocurrency, with crypto versions of many of the products offered by traditional financial firms, and without much of the red tape and regulations that govern the current financial system. Okay, so how big is DeFi? According to DeFi polls, DeFi's total value locked, or TVL, a standard way of calculating the value of crypto held in DeFi projects, is currently over $77 billion. If DeFi were a bank, it would be the 38th largest in terms of deposits in the United States. So not huge, but not small either. Right, TVL is not the only means to track DeFi's progress. Trading activity on decentralized exchanges has also increased by triple-digit percentages in the last year. You may also take a lead from authorities and lawmakers who are growing concerned about DeFi's rise. In a lecture at a blockchain conference in September, Michael Su, the acting U.S. comptroller of the currency, stated that many DeFi products reminded him of credit default swaps and other complicated derivatives that were popular on Wall Street in the years preceding up to the 2008 financial crisis. In a December CRIP, Massachusetts Democrat Senator Elizabeth Warren singled out DeFi to hearing, calling it the most dangerous part of the crypto world. In short, because DeFi is mostly unregulated, with few of the consumer protections and safeguards that exist in the traditional financial system. 4 ways DeFi can generate passive income. One of the most appealing aspects of decentralized finance is the possibility of earning a passive income and even handling payroll. Whether you connect to DeFi apps or dApps through decentralized Web 3.0 gateways or just through traditional web interfaces, many individuals and businesses are increasingly experiencing the benefits of having access to alternative financial goods and services. Because DeFi is decentralized, members can interact with them in a variety of ways, and the DeFi ecosystem is vast, with new components being added on a daily basis. Businesses, for example, are already embracing smart contract functionality to automate the terms of their interactions and investments, with DeFi smart contract tools assisting them in making the most of insurance pooling and escrow. Synthetics were prominent in early DeFi use cases thanks to decentralized synthetic hubs like Shadow's network. NFTs are also extending beyond collectibles at a rapid pace. Even content delivery, the basic fabric of the internet, is getting a decentralized facelift thanks to networks like AIOZ. The most intriguing component for regular DeFi participants, however, is how to easily generate a profit just by leveraging current crypto wealth. By staking your assets in DeFi protocols, you can receive a reward known in the industry as yield, allowing you to expand your crypto stack without putting it at risk through trading or other economic activities. While there are some hazards to consider while engaging with DeFi protocols, it is a very risk-free method of profit generation. You can earn a consistent residual income by yield farming, staking, and lending. All it takes is a small investment and a lot of perseverance. You will not get wealthy overnight, but your capital will grow over time. Furthermore, with a guaranteed income, you won't have to worry about the market dips that occur with cryptocurrency. Even if prices fall, you'll keep earning. In the video, we'll take a look at 4 of the most common ways to generate passive income in DeFi, as well as real examples of how they function. This video will assume you have a basic understanding of how crypto networks function and are comfortable with utilizing an Ethereum-based web wallet like MetaMask. It's also beneficial if you're familiar with prominent decentralized exchanges, or DEXs, like Uniswap. Method 1. Staking. Staking is the process of locking or staking tokens into a smart contract in order to earn more of the same token in return. The token in question is usually the blockchain's native asset, such as ETH in the case of Ethereum. Why would someone give you free tokens just to keep your existing tokens locked up? Apart from rewarding network users, that is the rationale for token incentives. Proof-of-stake blockchains rely on users locking their assets into special smart contracts. These are overseen by network validators, who are responsible for preserving the blockchain's consensus rules and ensuring that no one attempts to game the system. Validators who commit fraud may be fined by losing a portion of their share. Stakeholders are incentivized to lock up their assets for an extended period of time and earn rewards for contributing to the network's security and decentralization, because cheating makes no economic sense. Users that lock their ETH into the Ethereum 2.0 smart contract will receive additional ETH for their participation in enforcing the consensus rules. This process does not require manual supervision because it is automated. After depositing cash into the smart contract, you may leave the proof-of-stake mechanism to handle the rest while you claim your benefits on a regular basis. Because you must stake your funds for an extended period of time, in the case of Ethereum 2.0, this technique is best suited to customers that prefer a low time preference. Although the minimum stake in Ethereum 2.0 is 32 ETH, certain platforms use a pooling mechanism that allows you to deposit a less amount. Method number 2. Become a liquidity provider. Swaps between token pairings such as ETH and USDT are supported by decentralized exchanges such as Uniswap and SushiSwap. This liquidity is provided by pool tokens owned by liquidity providers, or LPs, which are ordinary DeFi users that deposit their tokens into the smart contract that controls the pool in question. As a result, you will earn a 0.3% fee on all swaps on Uniswap's DEX, proportionally to your pool share. The more deals you do through that pool, the more money you'll make. LPing does not always result in a profit. When the price of one of the pooled tokens swings considerably, you may lose money due to a process known as impermanent loss, or IL. However, there are ways to alleviate this by selecting highly liquid pools with less volatile assets, such as WBTC or ETH. You can maximize your profits by analyzing data from LP aggregators, which pool real-time data and assist you in projecting possible returns from multiple pools. Method number 3. Yield farming. When you invest in a DEX such as Uniswap, you will receive tokens representing your pool share. These tokens can then be locked into yield farms, which are effectively DeFi protocols that reward you with more or a different token. This means that while your pooled assets earn a portion of all Uniswap fees, your LP tokens can also be earned. When yield farming, it is critical to undertake due diligence on the platform and issue to ensure that it is trustworthy and that its developers do not intend to rug pull by stealing LP tokens and using them to withdraw liquidity from DEX pools. Choose well-known platforms with a good reputation and smart contracts that have been professionally audited. Method number 4. Lending. Lending platforms provide consumers with an APY in exchange for entrusting their assets to a smart contract. Borrowers then use these tokens to pay interest, a portion of which is refunded to the lender. For lending DAI, Compound Finance, for example, now offers an APY of 8.19%. There is no chance of the borrower failing to return their debt because the entire lending and borrowing procedure is managed by smart contracts. As a result, you should be able to withdraw your staked assets at any moment. So, I think we're at the end of the video, and I hope you enjoyed the video and it may be helpful in your crypto investment journey. If you liked the video, let me know in the comments section below and subscribe to the channel for more amazing videos. Thanks for watching!